Welcome to the Explainer. Look, if you've been wanting to seriously elevate your understanding of the financial markets, you are in exactly the right place. Today, we're going to build a comprehensive, cohesive stock market survival guide from the ground up, and we are tailoring it specifically for the dynamic Indian markets.
Now, to really grasp the playing field we're navigating, we have to talk scale. As of late 2025, the NIFTY 50 boasts a market capitalization of roughly 209 lakh crore rupees. To put that into perspective, that's equivalent to an astonishing 2.2 trillion US dollars. It's an arena of just immense scale, massive liquidity, and huge opportunity. But it's also a landscape that absolutely requires precision tools if you want to navigate it and, more importantly, survive. So here's our game plan for today. We'll start at the macro level with the Indian Market Barometer and SEBI, the market watchdog. Then we'll rethink market capitalization before zooming all the way down to the micro tools, reading price action, and managing your trading risk. Let's dive in. Section 1. The Indian Market Barometer, Understanding the NIFTY 50. Okay, think of the NIFTY 50 as our benchmark. It's the free float weighted average of the 50 largest, most liquid Indian companies listed on the National Stock Exchange. And it acts as a true economic barometer because it actually covers 13 incredibly diverse sectors of the Indian economy. But it's worth noting the distribution. It is heavily weighted towards financial services, making up nearly 37% of the entire index. Then you've got oil and gas at about 10.4% and information tech right behind it at roughly 10.2%. This specific weightage is what gives investment managers such comprehensive exposure to the broader market in just one single portfolio. And the history of this index. It's basically a masterclass in growth and resilience. Since hitting a base value of 1,000 back in December of 1999, the index has just powered through multiple economic cycles. I mean, it crossed 10,000 in July 2017, soared past 25,000 in August 2024, and reached record highs of over 26,328 by January 2026. It literally proves how consistently the market bounces back and expands over the long term. Moving right along to Section 2, CBI, the market watchdog, the referee of the Indian stock market. You know, historically, investors actually lost faith in the Indian markets because of widespread malpractices, things like price rigging and insider trading. It was kind of the Wild West. To fix this, SEBI was established in 1992, and today it essentially wears three hats. First, its protective function safeguards us against fraud. Second, its regulatory function keeps a super tight leash on brokers and exchanges. And third, its developmental function promotes technological growth and financial literacy. And to actually enforce all this, SEBI wields quasi-legislative powers to write the rules, quasi-judicial powers to settle disputes, and quasi-executive powers to conduct investigations and penalize the bad actors. They are there to guarantee the game is fair for everyone. All right, Section 3, Rethinking Market Capitalization, Understanding the Market's Weight Classes. So I like to think of equity markets like Olympic weightlifting, right? A 55-kilo lifter obviously shouldn't be competing against a 96-kilo lifter. Traditionally, the term large cap simply refers to the top 100 companies. But actually, when you dig into the numbers, that logic has a massive flaw. In most market tiers, a company might be compared to another that's maybe 3 or 4 times its size. But in that traditional large cap category, a company sitting at the bottom of the top 100 could be compared to a giant at the very top that is an astonishing 52 times its size. There is no way that's comparing apples to apples. To fix this mathematical distortion, financial researchers have come up with a much more logical classification. We just split that top 100 category. We carve out the top 30 companies and put them into a distinct mega-cap class, which leaves the next 70 as the large 70. Doing this instantly brings the size disparity back in line with the rest of the market tiers. It makes our performance and risk comparisons so much more accurate. So why does redefining this actually matter to your wallet? Well, it's all about the risk-reward trade-off across these weight classes. Naturally, smaller caps offer higher average returns, but the standard deviation is massive, which drastically increases volatility. So yes, smaller caps offer this huge upside potential, but they come with a significantly higher risk of downside compared to the much more stable mega and large 70 caps. Which brings us to Section 4, Reading Price Action, the micro tools of the trade. Okay, now that we've assessed the macro market players, let's zoom all the way in. Let's look at the exact micro tools traders use to analyze historical price patterns in real time. The absolute cornerstone of this is the Japanese candlestick chart.
Believed to have originated with 18th century Japanese rice traders and then brought to the West in the 1990s, every single candlestick gives us 4 crucial pieces of data for a given time period: the open, the high, the low, and the close. The thick central part is called the real body, and those thin lines extending out, those are the shadows, or wicks, which show us the highest and lowest price excursions during that specific session.
What's brilliant is that reading price action is just incredibly visual and immediate. A hollow or green candle, that means the closing price was higher than the opening. Buyers were in complete control, making it bullish. A filled or red candle means the asset closed lower than it opened. The sellers took over, making it bearish. In a fraction of a second, you can gauge overall market sentiment just by looking at the color and the length of the body. And finally, Section 5, Managing Trading Risk, Protecting Your Capital with Position Sizing. Look, here is the harsh truth. Knowing how to read charts means absolutely nothing if you wipe out your trading capital. Your absolute best shield against market volatility is position sizing. And the golden rule here is elegantly simple. Ensure you never risk more than a predetermined percentage of your trading capital on any single trade. Professional traders, they usually keep this somewhere between 0.5% and 2%. Using a strict, systematic approach like this completely removes emotional decision-making. And research consistently shows that disciplined risk management is way more vital to long-term profitability than having some magical strategy with perfect market entries.
So, the crucial takeaway is that this formula takes all the intimidating math out of risk management, turning it into a highly repeatable recipe for survival. Step 1. Calculate your total risk amount by multiplying your account size by your risk percentage. Step 2. Calculate the risk per share, which is just your planned entry price minus your predetermined stop-loss price. And Step 3. Simply divide your total risk by your risk per share. That result is the exact precise number of shares you should buy.
Let's actually plug in some real numbers to see this in action, all right? Say your total account size is 2 lakh rupees, and you're sticking to a disciplined 1% risk rule. That means the absolute maximum you're willing to lose on this specific trade is 2,000 rupees. Now, let's say you want to enter a stock at 1,200 rupees, and your technical chart reading tells you to place your stop loss at 1,150. Well, that's a 50 rupee risk per share. Divide your 2,000 rupee maximum risk by that 50 rupees, and you get exactly 40 shares. See? This strict mathematical calculation strictly caps your potential loss while still letting you confidently participate in the trade. Which really brings us to the ultimate question. Knowing the immense scale of this market, understanding the varying volatility across different market caps, and having these technical tools at your disposal, are your current trading positions mathematically sized to survive the next inevitable shift in volatility? I challenge you to take this toolkit we built today and immediately apply it to your own portfolio's risk management. Thank you so much for joining me on this explainer, and keep learning.